How's it going, everybody? We're back again for another VAR video where we review tax advice online and we determine if it should be shown a red card, yellow card, or if it's valid. Of course, if we're meeting each other for the first time, my name is Ronnie Foguin. I'm a CPA who helps Canadian and American content creators build wealth through effective tax planning. We help generate 4 to 5 figures in tax savings. And without further ado, let's hop right into it. So we got a Dave Ramsey video, companies do not pay taxes. Let's check it out.
The companies do not eat taxes. We're going to raise corporate taxes. No, you're not. You raise corporate taxes. Corporate taxes are built into the price of the item you buy from Walmart. Walmart does not pay taxes. You pay taxes when you buy potato chips at Walmart. You pay all their taxes for them. It's built into the price. They don't work for nothing. Mm-hmm. You can't raise corporate taxes. It's impossible. All you do is raise prices to the consumer.
I think Dave Ramsey is confusing two different taxes here. Let's really dive into it. So there's a lot of rhetoric where people say, like, you know, when governments pass bills, for example, trying to levy more corporate tax, people just say, oh, it's going to be passed on to the consumer and stuff like that. There's some truth to it. We just have to discern what we're really talking about here, right? So if a government is trying to impose a tax on unrealized gains, which are investments or like profits, like saying, okay, like a company has stock value from generating income year in, year out, so their stock goes up, but because stock hasn't been sold, we're going to tax the unrealized gain. That tax rate, that tax bill is not going to be passed on to the consumer. They're not going to be like, oh, let's raise prices because of that. Like, that's like income tax, capital gains tax to be specific, so that's different. What Dave Ramsey is referring to, I guess the video, it sounds like he was referring to corporate taxes, so income tax. Income tax does not increase prices for consumers. Because if you think about it, income tax is based on the revenue generated. So by increasing the price of a product, they would thereby be increasing their own income tax. So in no way, shape, or form is this statement correct from Dave Ramsey. However, I know what Dave Ramsey is referring to is just a bit misleading when he's saying corporate tax. Dave Ramsey is referring to something we call gross receipts tax. And this is going to be United States jurisdiction. So for my Canadians, tap in, listen in, be curious, but this is more so focused on US jurisdiction here. A lot of corporations in certain states, they not only are imposed income tax, which means tax applied on their income generated, so their revenue minus expenses. They also have to pay certain other taxes like franchise taxes. So say, for example, if you register your LLC in California, there's a franchise fee just for having it. Delaware, franchise fee just for having it there. But what Dave Ramsey is referring to here is gross receipts tax. And gross receipts tax is a tax imposed. It's a flat tax. Like, say, for example, you're making a certain amount of revenue. So not net income, but revenue. So price times quantity. If you're making a certain amount of revenue, we're going to apply, let's say 2%. Like, it's not going to be a high nominal tax rate like 10 to 50%, but let's apply 2% to that revenue amount, and we're going to call that the gross receipts tax. For example, in Texas, if you have an LLC that's earning more than $1 million, I don't know the number off the rip, but I know it's over $1 million of revenue, there's going to be a gross receipts tax, a flat number, it's not progressive, applied to that revenue number, and it's going to be charged to the LLC. Now, what we're seeing here is a company is generating revenue, so price times quantity, and if it exceeds a certain threshold, they have to pay a flat gross receipts tax on that amount. And what companies do at that point, because this isn't based on income, this is based on revenue generated. And they're like, okay, for my margins to be right, so like for my take home, so for what the company keeps to be right, if I'm going to be taxed 2% on this revenue of $10, well, I'm going to up the price then. I'm going to up the price to, let's say, $14 because my cost is still the same. It's just I have to increase my price because I have to factor in this tax that's being offset. So now if we're going from a perspective of a supply chain, like say, for example, to make a Beyblade, you have to get the metal wheel, you have to get the plastic design, you have to get the zip thing, you have to get, I'm butchering all the names, but y'all get the concept. You got to get the cowl on top, and then you got to get the whole set, the stadium where they play. So all of these supply chains, when they pass on to each other to build it, they're going to add a markup because they know that they have to factor in gross receipts tax, and that markup increases the price, so that when the consumer, which is, you know, our kids or us when we were younger, trying to get a Beyblade, like I want to let it rip like they do on TV, you know, something that at the root cause at the root without gross receipts tax would have cost $10. Now you're getting hit with 20. So in that way, it's very similar to tariffs, right? If we're looking right now, there's a tariff crisis, obviously, because Trump is on an Oprah trip where he's saying you get a tariff, you get a tariff, you get a tariff. If we're applying that concept, it's the same thing. Is the exact same thing with tariffs. If people have to pay extra to import goods, they will transfer that fee to the consumer so that they don't have to pay it. It's just purely simple macroeconomics. So in terms of my VAR review for Dave Ramsey, I feel like I have to give him a yellow card here because it's kind of misleading. Misleading because it goes on a rhetoric where like the government can never levy corporate income taxes because it'll just be passed on and they'll always avoid it. It depends on what you're referring to, but not this. That doesn't apply to income tax. That applies to gross receipts tax. If you guys are enjoying my VAR series, let me know in the comments, man. Like, comment, subscribe, all that good stuff. If you guys want a specific video you've seen online reviewed in VAR, make sure to tag me in it. I'll make sure to add it. That's about it. Again, if we're meeting for the first time, my name is Ronnie Foguin. I'm a CPA who just helps maximize tax planning for Canadian and US creators. That's it for me. I'll see y'all in the next video.